Let us start with the mock test paper of CA Intermediate Financial Management Part 8A. We are starting with the mock test paper of November 2021 examination, which is delayed to December 2021, and we are starting with the mock test paper 1 series. As usual, we will be doing the entire question paper, and afterwards I'll give you a summary and I'll give you certain comments from my end that what is the sequence in which you should have appeared for the examination paper, and will give you some comment for the individual questions. So let us start with the answers. I'm reading the basic instruction. Answers are to be given only in English except in case of the candidates who have opted for the Hindi medium. If a candidate has not opted for Hindi medium, his or her answer in Hindi will not be valued. Question number 1 is compulsory, and attempt any 4 questions from the remaining 5 questions. Workings should form part of answer. The reason that I read always this instruction is that number of times institute is providing in the initial information that the answers are required to be written in how many decimals. So if at all such kind of clarification is made in the question, then in that case it is mandatory to follow that for doing answer. Dear students, starting with the question number 1A. Question number 1A speaks like this. In respect of two companies having same business risk, the following information is given. Capital employed is given an amount of rupees 4 lakhs. Operating income is given an amount of 60,000. K is given 12%. Levered company, levered stands for a company which has introduced the debt financing in the capital structure, is considered to be levered. An unlevered company means a company which does not have debt financing. In total, it is 3 lakhs of rupees in both the cases. However, the capital structures are different. Investors holding 20% shares of levered company. Calculate, highlight the portion, increase in the annual earning of the investor if he switches over his holding from levered to unlevered. That is a question. So the question says that if at all an investor is entering into arbitrage transactions, yes, over here we are required to apply the concept of the arbitrage, and we are required to show that what will be the increase in the income if at all the investor is switching over from levered to unlevered. So first of all, let us make the calculation of the value of the equity, value of the firm, and based on that, we'll make the calculation of answer. So let us first of all calculate the value of the firm. Dear students, over here, we have been provided with the information about the operating income. Interest information is also provided to us. And with that, we can compute the earning before taxes. Earning before taxes itself is earning after taxes because the tax rate information is not given. And only in that case, the arbitrage opportunity is existing. Dividing the same with the cost of equity, because an assumption is made that whatever the earning of the company is distributed in form of equity dividend. So earning divided by cost of capital will give the value of equity, and to that value of the debt will be added to compute value of the firm. So let us start calculating the answer. Working note number 1. Calculation of value of firm. We have been provided with the two companies. One is levered and another is unlevered. As far as the operating income is concerned, EBIT, it is an amount of rupees 60,000. The levered firm has 1,50,000 rupees of the debt financing, having rate of interest of 10%. So this is 60,000. Less interest 1,50,000 into 10%. That comes to 15,000. Earning before taxes is 45,000. No tax, so earning after taxes is again 45,000. The entire earning is assumed to be distributed in form of equity dividend. So this will be divided with the cost of equity. That is given to us at the rate of 12%. So earning after taxes of 45,000 divided by 0.12, that gives 3,75,000. That is the way the value of equity is calculated. It is 45,000 rupees divided by 0.12. Value of debt will be added to the value of equity to compute value of firm. We understand that in respect of the debt valuation, no specific information is given, and usually that kind of information is not given to us at this level. Otherwise, the debt is also required to be valued, taking into account certain information. However, at this point of time, we don't have to do it. Of course, at CA final level, you are going to do it. And with this, we can compute the value of the firm. That is 5,25,000. It is 3,75,000 plus 1,50,000. Okay. This is the value of the levered firm. Now we are required to do similar working for unlevered firm. In that, so the operating income is 60,000. Amount of interest is 0. Why? Because it is unlevered. It means that it does not have any committed sources of finance. Earning before taxes will be again 60,000. So the earning after taxes is 60,000 once again. Cost of equity is 12%. So 60,000 divided by 0.12, that comes to 5 lakhs. Value of the equity will be 5 lakhs. That is 60,000 rupees divided by 0.12. As far as the value of the debt is concerned, it is a 0 because it is an unlevered firm. Value of the firm will be total 5 lakhs. Dear students, over here we can see that the levered firm is overvalued. So of course an investor can switch over from levered to unlevered for the purpose of arbitrage. This time the question is providing a very good clarity that an investor holding 20% shares in levered company. Now this levered company clarification may not be given. The question only may provide that an investor holding 20% equity shares in overvalued firm is entering into arbitrage. In that case, you have to understand that the investor is holding 20% equity shares of the levered firm. So just be careful. This is the first point. Second thing that we understand that the question is providing the information with respect to the percentage of the shares held by the investor. So here investor is holding 20% shares is given to us. If at all such clarification is not made, then in that case you just have to make an assumption that an investor is holding a certain percentage of the equity shares, and with that say the calculation can be made. Okay. Now going further, he switches over to the undervalued firm, and with that, so we are required to make the calculation of arbitrage. Generally, I suggest students to do answer like this. Step number 1. Current position of investor holding 20% equity shares in levered company. So the first situation wherein we understand that step number 1, in which we understand that we will identify that what is the current situation of the investor. In that, there are 3 things that I tell students to identify. One is the investment, second is the income, and the third is exposure to debt risk. There are 3 things. So the first thing is that's the income. We understand that as far as the levered firm is concerned, its earning after taxes is 45,000 and investor is holding 20% equity shares. So what will happen? It is 45,000 into 20%. That comes to rupees 9,000. That is, first of all, we can make the computation of the current income. Next is investment. Value of the equity is 3,75,000 and investor is holding 20% equity shares. So it is 3,75,000 into 20%. That comes to rupees 75,000. That is the way the income and investment can be calculated. And the last is exposure to debt risk. In a way that the investment is made right now in a levered form, so there is a positive exposure to debt risk. That is 20% of 1,50,000. So 1,50,000 into 20%, that comes to 30,000. This is the way we are supposed to make the computation of the current position of the investor. Step number 2 is very simple. Investor will be advised to sell investment of levered firm. Full stop. In that, with this, investor will receive an amount of rupees 75,000. That is 3,75,000 into 20%. That is step number 2. Step number 3, in that we understand borrow. Dear students, we understand that as per MM approach, because this question is basically of the MM approach arbitrage, and assumption is made that the corporate leverage can be substituted with the personal leverage. So in order to keep the debt exposure same as it was earlier, an amount of rupees 30,000 will be borrowed. What is the rate of interest at which it will be borrowed? Is very simple. It is at the rate of 10%. because making investment in unlevered firm will not have any exposure to debt risk. So borrow, in that write down, borrow rupees 30,000 at the rate of 10% to keep debt exposure same. That is step number 3. Step number 4, calculation of increase in income. Now friends, it is very simple for us to understand that the investor is going to make the entire amount of investment in unlevered firm, that is only equity. So in that, so the investment will be made. So in that, first of all, investor is going to receive dividend income. See what will happen. Earning after taxes of unlevered firm is 60,000 and the total value of the equity is 5 lakhs. So what will happen? The investor will purchase proportionate equity. So what will happen? It is 60,000 divided by 5 lakhs into this is 30,000 and this is 75,000. So in total it comes to 1,05,000. 75,000 plus 30,000. Okay. So we understand that over here 75,000 plus 30,000, that comes to 1,05,000 into 60,000 divided by 1,50,000. So the dividend income is going to be an amount of rupees 12,600 less payment of interest. See, this 30,000 rupees is borrowed. The rate of interest of borrowing is 10%. So that comes to an amount of 3,000. So this is the way we can find the revised income. The revised income is 12,600 minus 3,000. That comes to 9,600. Now importantly, what we can see that this revised income of 9,600 is greater than the current income of 9,000. So there is an increase in income by rupees 600. That is the way we can make the calculation of increase in income. By rupees 600. How this is calculated? 9,600 minus 9,000. This is the way increase in income can be calculated. So let us have the revision of the entire answer. In this question, the question is expressly providing that you are required to make the calculation of arbitrage. First of all, we have made the calculation of the value of both the firms. We understand logically that the investor of overvalued firm will switch over to the undervalued firm for the purpose of arbitrage. First of all, we have identified that what is the current situation, current position of the investor holding 20% equity shares in overvalued firm, that is levered firm in this example. What is his current income, investment, and importantly, what is the exposure to debt risk? This is something which I feel is important. A simple assumption has been made by all the capital structure theories that all the earning will be paid in form of dividend. Second step is simple, wherein we'll advise him that you sell your investment. Third step is the step in which, in order to keep the same debt exposure, there will be a borrowing of rupees 30,000 at the rate of 10%. Step number 4, in that there will be an increase in the income, wherein we understand that the revised dividend income will be calculated considering the investment that we have made and considering the income that the unlevered firm is able to generate. Whatever the borrowing that we have made, for that there will be interest payment. That is the way the revised income is calculated. In comparison to the existing income, it is more by 600 rupees. Next question. The following is the capital structure of Sharda Limited as on 31st of December 2020. Equity shares, 2 lakh equity shares are funded. That comes to an amount of 2 crore. 9% preference shares, 60 lakhs. 8% debentures, 90 lakhs. So the total is 350 lakhs. P0, market price of equity share is 120. It is expected that dividend will be rupees 12 per share and it would be declared for the year 2021. So the dividend information is given. Growth rate is 5% and income tax rate is only 30%. The question says that calculate the company's weighted average cost of capital. Second part of the question. Further, in order to finance the expansion plan, the company needs to borrow a fund of rupees 2 crore bearing 12% rate of interest. In this situation, what will be the revised WACC, weighted average or overall or composite cost of capital? This financing is expected to increase the dividend from 12 to 14. However, the market price of the equity share is expected to decline from 120 to 150. In both 1 and 2 above, highlight the portion market value weight while calculating the weighted average cost of capital. That is what they have provided. It means that we are required to compute the weighted average cost of capital using market value approach. So friends, over here, we are required to make the computation of the weighted average or overall cost of capital for 2 times. First of all, it is required to be calculated using the existing capital structure and then considering the expansion of the business. So there are 2 times we are required to make the calculation of answer. Understanding that how to make the calculation of answer, everybody is requested to pay attention. In respect of preference share and in respect of debenture, no information is provided for the redemption. So assuming that these securities are issued for perpetuity, we'll make the calculation of cost of capital. In case of the equity share, very good clarification is made that this is D1 and 120 is DC, that is P0. With that, we'll make the calculation of answer. So write down answer of the question. Heading is WACC, weighted average cost of capital, or it is also given a name as overall cost of capital. I request all of you to write down answer along with me. Step number 1, calculation of cost of capital. In that, we are required to compute 3 cost of capitals: preference shares, debentures and equity shares. So there are 3 cost of capital to be found. As far as the cost of equity is concerned, it is D1 upon P0 plus C. What is D1? D1 is rupees 12. What is P0? P0 is 120 and growth rate is 5%. So 12 divided by 120 plus 0.05. So 0.10 plus 0.05, 0.15, that comes to 15%. That is the way the KE can be calculated. Then cost of preference share. As I told you that we are making an assumption that the security is issued for perpetuity, and accordingly we make the calculation of preference share cost. Preference dividend divided by amount. We have been provided with the information that the preference share capital is having a face value of 100 rupees. Rate of dividend is 9%. No information is provided for the issue price, neither market price is given. So we assume that the face value is equal to the face value itself is the market price. So 100 into 9% divided by 100. So 9 upon 100, that is 0.09, and that comes to 9%. This is the way cost of preference share is calculated. Next is cost of debenture. In that, it is interest into 1 minus t divided by amount. Because the payment of the interest is tax deductible, that is the reason. No information is given for the face value of the debenture. So we'll make the calculation on the total value. And income tax rate is only 30%. And the rate of interest is 8%. So what will happen? It is 90 lakhs into 0.08 into 1 minus tax rate divided by the amount is 90 lakhs once again. So 90 lakhs into 8%, that comes to 7,20,000 into 0.7, that comes to 5,04,000. Divided by 90 lakhs into 100. That comes to 5.6%. This is the way cost of debt financing can be found. So in step number 1, we make the computation of the cost of the individual source of finance. Step number 2, calculation of weight / proportion of each security in capital structure. Column number 1 is source of finance. Column number 2 is amount. Column number 3 is weight or proportion. As far as the source of finance is concerned, in that there are 3 sources of finance. It is equity, preference, and debentures. It is equity share capital, preference share capital, and debentures. So as far as the amount is concerned, in that we can see it is 2 lakh is the number of equity shares and the market price is 120. So it is 2 lakhs into 120. That comes to 240 lakhs. Regarding preference share capital and debentures, we'll assume the book value itself is the market value because no information is given to us. So 60 and 90. So 60 lakhs and 90 lakhs. So use a calculator. 240 plus 60 plus 90. That comes to 390 lakhs. So the proportion is 240 upon 390. 0.6154. $240 lakhs divided by 390 lakhs. Then 60 upon 390. That comes to 0.1538. It is 60 lakhs divided by 390 lakhs. And the last one will be found as balancing figure. It is 0.6154 plus 0.1538. Total of both of them is 0.7692. That is deducted from 1. So it is 0.2308. So the total is 1. Of course, this 0.230 is found as balancing figure. Even if at all you make the calculation like this, 90 upon 390, you will get an answer which will be very near to this answer. 90 upon 390. So it is 0.2308. We get exactly the same answer. That is the way we compute the weight or the proportion in which the funds have been raised. Next will be calculation of the weighted average cost of capital. See, the cost of capital for the individual source of finance is calculated by us. Proportion in which we raise the funds is also calculated by us. So step number 3, calculation of weighted average cost of capital, or it is given a name as overall cost of capital. Again, column number 1 is source of finance. Second column will be weight or proportion in which we have raised the funds. Third column will be cost of capital, and the last column will be weight into cost of capital. So it is equity share capital, preference share capital, and debentures. The proportion is 6154. Then it is 0.1538. Then it is 2308. Multiplying with the respective cost of capital. This is the cost of capital: 15, 9 and 5.6. 15, 9 and 5.6. That is the way the weighted average or overall cost of capital can be found. So it is 0.6154 into 15. 0.1538 into 9. 0.2308 into 5.6. That is the way weighted average or overall cost of capital can be found. So now we will be having 0.6154 into 15. That comes to 9.23. 0.1538 into 9. That comes to 1.38. 2308 into 5.6. That comes to 1.29. Based on this, we can compute the weighted average cost of capital. Total is 11.91. That is 9.23 plus 1.38 plus 1.29, okay, 11.90. That is the way weighted average or overall cost of capital can be calculated using the existing capital structure. Now friends, many a times students have a point to ask me that, sir, can we combine the second step and third step? The answer is yes. If at all you want to combine, you may combine. We already have found the proportion over here. The cost of capital has already been found in step number 1. So product of both of them and summation of that, that is the way you can make the calculation of the weighted average cost of capital. Okay. Next, second part of the question. We are going to have the expansion of the business, and with the that is for expansion, an amount of rupees 2 crore is required, and the rate of interest is provided as 12%. The question says that, say, if at all we do like this, then in that case the price of equity share and the amount of the dividend per share will change. The price will fall down to 115, and so the dividend will increase to rupees 14. So we are required to take into effect, that is, take into account this cost of equity, that is revised cost of equity. Second, cost of this debt financing, that we are required to take into account, and afterwards we'll compute the revised weighted average cost of capital. So the sequence in which we are going to prepare the working note will be like this. First is calculation of the revised cost of equity. Second is calculation of the cost of debt financing. Third is calculation of the proportion in which we have raised the funds. And lastly, weighted average cost of capital. So please write down answer for the second part of the question. In that step number 1, calculation of cost of capital. This working note will be divided into 2 parts. One is revised cost of equity. How will compute the same? It is D1 divided by P0 plus C. As far as the dividend is concerned, we understand that so the amount of the dividend is rupees 14. Yeah, this is 14 and P0 is 115. Plus growth rate. The question is not providing the information about the revised growth rate, so we assume that the growth rate will remain same, that is 5%. Plus 0.05. That is the way revised KE is calculated. Next is the cost of debt financing. In that, interest into 1 minus tax rate divided by amount. So 14 upon 115, that comes to 0.1217 plus 0.05. So 0.1717. That is 17.17%. Now, as far as the cost of debt financing is concerned, we can see that the information is given. We are going to borrow 2 crore, rate of interest is 12% and tax rate is 30%. So it is 200 lakhs into 12%, that is the rate of interest, into 1 minus 0.30 divided by again 200 lakhs. So 200 into 0.12, that comes to 24 lakhs. 24 lakhs into 0.7, that is 16.8 lakhs. divided by 200 lakhs, that comes to 0.084. That is 8.4%. This is the way post-tax cost of debt financing is calculated. Next per keynote will be the proportion. So friends, what will happen? Now instead of 390, there will be additional 200. Accordingly, we are required to make the calculation. And further, so this market price of the equity share is also changing. So accordingly, we are required to compute the value of the equity. So step number 2, calculation of weight / proportion in which funds have been raised. In that, column number 1 will be source of finance, column number 2 will be amount, column number 3 will be weight or proportion. As far as the source of finance is concerned, it is equity share capital, then preference and debentures. Preference share capital, debentures, and there is an additional debt financing. Which we have recently raised an amount of 2 crore. As far as the number of equity shares are concerned, that is 2 lakhs, and market price of the equity share is now 115. So 2 lakhs into 115, that comes to 230 lakhs. That is 2 lakh is the number of shares, into 115 is the market price per share. Accordingly, we are required to do further answer. So, in case of the preference share capital, it will be as it is 60 lakhs, 90 lakhs. This is 60 lakhs, this is 90 lakhs. Additional debt financing of 2 crore, that is 200 lakhs. So use your calculator, 230 plus 60 plus 90 plus 200, that comes to 580 lakhs. The proportion in which we have raised the funds is 230 upon 580, that comes to 0.3966. $230 upon 580. Next is 60 upon 580. That comes to 0.1034. Then 90 upon 580. .1552. Total is 1. So the additional debt financing will be found as balancing figure. 3966 plus 1034 plus 1552, all of them are subtracted from 1. So 3448. If we compute, then in that case it is 200 upon 580. It is 3448 exact. Otherwise, it may be having some marginal differences because of the approximation. Okay. The last step will be weighted average cost of capital. So step number 3, calculation of WACC. Column number 1 is again source of finance. Column number 2 is the weight of proportion in which we have raised the funds. Third column is cost of capital, and the last column is weight into cost of capital. That is what we understand. So it is equity share capital, preference share capital, debentures, and additional debt financing. The proportion is 3966. Next will be 1034. 1552. And the last is 3448. Multiplying with the respective cost of capital. As far as the equity is concerned, it is 17.17. For preference share and debentures, there is no change. So it is 9 and 5.6. That what we already have found earlier. As far as the debt financing is concerned, for that it is 8.4. Now, many a times students are having a question to ask me that, sir, can we calculate the cost of debt financing directly like this? 8% into 1 minus 0.3. Cost of additional debt financing 12 into 1 minus 0.3. Can we do answers like this? The answer is yes, subject to the condition that there is no flotation cost, there is no premium at the time of issue of the security or discount. At the time of redemption also, there is no premium discount. Subject to fulfillment of all these conditions, you can go for this kind of shortcut formula for KD or for KP, because for KP also it is 9%, but in that case, say all these conditions are required to be fulfilled. So cost of capital into weight, that is the way weighted average or overall cost of capital will be calculated. So 0.3966 into 17.17. That is 6.81. 0.1034 into 9. That comes to 0.93. 0.1552 into 5.6. That comes to 0.87. Point 3448 into 8.4. That comes to 2.90. So what will happen? The total is 10.64 approximately. That is weighted average cost of capital or overall cost of capital. Let us check once again. 6.81 plus 0.93 plus 0.87 plus 2.90. That comes to 11.51. So it is 11.51. That is the weighted average or overall cost of capital. So let us have a summary of the entire answer. We understand that over here, first of all, that is the question is about the weighted average cost of capital calculation. So taking into account the price of the security, dividend, we make the computation of the cost of equity and growth rate, of course. Then cost of debenture and cost of preference share. For that, assumptions have been made. One, the issue of the securities for perpetuity. Second, the security is having the market value equal to the face value. Second is the calculation of the weight or the proportion in which the funds have been raised. That is the amount divided by the total value. That is the way weight or proportion is found. Third step is weighted average or overall cost of capital, in which the proportion and the cost, we multiply both of them and we compute the weighted average or overall cost of capital. The second part of the question is a kind of extension of the first part of the question, wherein the question says that say we are going to expand our business, and for that say we are going to have the additional debt financing. It will have the impact like one, amount of dividend will change. Second, price of equity share will change. So cost of equity will be revised. And of course, we are required to take into account that what is the cost of the new debt financing that we have raised. Based on that, say we compute the cost of capital. Next is weighted average cost of capital. There is a very good clarification made in this question that say the weighted average cost of capital is required to be found based on book, that is market value approach. If at all any clarification is not made, then in that case you can put a note that say you are doing the weighted average cost of capital using the book value or market value. Doing answer by either of the method is correct. If at all there is no clarification, my suggestion is that say usually make the calculation using the book value approach, because that is the way generally they provide suggested answer. Question number 1C. ABC Limited has total sales of rupees 10 lakhs, all of which are credit sales. Means credit sales is 10 lakhs. It has gross profit ratio of 25%, means COGS is 75%. Current ratio is 2. So current assets is every 2 rupee for every 1 rupee of current liability. The company's current liabilities are rupees 2 lakhs. So 2 into 2, it will be 4 lakhs, that is the current assets. Further, it has inventories of rupees 80,000, marketable securities 50,000, and cash balance of 30,000. So we have been provided with certain identification of the current assets. From above information, the questions are: calculate average inventory if expected inventory turnover ratio is 3 times. Second question is: calculate the average collection period if the opening balance of the debtors is expected to be 1,50,000. That is a question. So let us understand how to make the calculation of answer. So friends, over here we understand that the question is providing the information about the sales. GP ratio is 25%. So use your calculator. 10 lakhs minus 25%. COGS will be 7,50,000. The question is providing the information that inventory turnover ratio is 3 times. So COGS of 7,50,000 divided by 3. So we understand that so the average inventory will be an amount of 2,50,000. That is the answer of the first part of the question. Second part of the question. In second part of the question says that so you are required to compute the average collection period. How to do that? So we'll just discuss that in 2 minutes of time. First of all, let us make the calculation of average inventory. So answer of the question. Working note number 1. Calculation of COGS. It is sales minus gross profit. Sales is 10 lakhs minus gross profit It is 10 lakhs into 25%. So 10 lakhs minus 2,50,000. That comes to 7,50,000. This is the way, first of all, COGS will be found. Afterwards, calculation of inventory turnover ratio. Calculation of average inventory using inventory turnover ratio. Dear students, it will be calculated like this. COGS upon inventory turnover ratio. So what is the value of the COGS? It is 7,50,000 divided by 3. That is 2,50,000. This is the way average inventory can be calculated. The second part of the question says that you are required to compute the average collection period. And for that, the opening balance of the debtors is given. Dear students, over here, we understand something like this. Calculation of ACP, average collection period, wherein again the clarification is made that you have to take 360 days in a year. So we'll apply the formula like this: 360 days divided by annual credit sales. Multiplied with, friends, over here we are required to write average debtors. Since the information is provided to us regarding opening debtors, so definitely we can make the computation of the average debtors for doing answer. If at all the information regarding the opening debtors is not given, then in that case, whatever the debtors that say we can compute based on the current ratio, we have to assume that the closing debtors itself is the average debtors, and we have to do answer. So basically what happens, and you have to understand that whether you are supposed to take the average debtors or the closing debtors. We have to take the closing debtors for calculation of collection period if at all the average information is not possible to find. That is not possible to find. Okay. So that's very simple to understand. As far as the average debtors is concerned, it will be calculated as opening plus closing divided by 2. That is the way the average will be calculated. Opening is given, so closing is required to be found. For calculation of the closing debtors, we will take into account the current ratio, we will take into account the current liabilities, and other assets information which have been given, that we will take into account. So write an answer of the question. Working note number 1, calculation of closing balance of debtors. Let us see how to calculate the same. For that, we understand that the cash balance plus stock plus marketable securities plus debtors. Total of all this is what we understand is the current assets. Fine. Now basically we are required to make the computation of the debtors. So keeping debtors on this side, all other things will be transferred on the opposite side. So the debtors is equal to, what is the value of the current assets? It is current liabilities into 2. Why? Because the current ratio is 2. So we can write it like this: current liabilities into current ratio. minus what is the amount of the cash balance? Let us see. Amount of the cash balance is 30,000. Amount of the marketable securities is 50,000 and stock is 80,000. Okay. So we understand it is 30,000, 50,000 and 80,000. What is current liability? 2 lakhs into current ratio 2 minus 3 plus 5, 8, 8 plus 8, 16. 4 lakh minus 1 lakh 60,000. That comes to 2 lakh 40,000. This is the way so the datas can be calculated. Of course, this is a closing datas. Now using the opening datas and closing datas, we can make the calculation of the average datas, and that will be useful to calculate the average collection period. So working note for calculating average datas. It is opening balance plus closing balance into 1 by 2. The opening balance is provided to us in the example as 1,50,000. Plus closing balance, that is 2,40,000. Divided by 2. $1,95,000. Now based on this, we'll make the calculation of average collection period. It is 360 days divided by annual credit sales into average debtors. So 360 days divided by annual credit sales is 10 lakhs into average debtors is 1,95,000. $70.2. That is very near to 70 days. This is the way average collection period is found. Let us see the next question. Question number 1D. M Limited belongs to a risk class with a capitalization rate of 12%. Means the investors have the return requirement of 12%. It has 40,000 outstanding shares and current market price of the share is rupees 200. So P0 is provided to us as rupees 200 and N number of shares outstanding is given as 40,000. It expects net profit of 5 lakhs for the year end, for the year, and board is considering a dividend of rupees 10 per share. M Limited requires to raise an amount of 10 lakhs for an approved investment expenditure. Illustrate how MM approach, that is Modi-Ginani Miller approach, affects the value of the M Limited if dividend are paid or not paid. So friends, over here, this is a question of the dividend policy. Using MM approach, we are required to answer that. You are required to prove that value of the firm will remain same whether dividend is paid or not. So we are required to do the valuation of the firm in both the situations, whether dividends are paid or not. Now friends, as far as this question is concerned, We are required to do valuation of the firm in both the situation, whether the dividend is paid, dividend is not paid. That is the first thing. Second thing that we understand is we are required to make the calculation of answer usually in 3 steps. That is what I suggest to students. Step number 1 is calculation of the P1, that is market price of the equity share at the end of first year. Second step is calculation of the delta N, that is change in the number of shares. And third step will be calculation of the NP0, that is valuation of the firm. That is the way, so these are the 3 steps in which we have to work out the answer. So let us answer the question. Answer for question number 1D. Step number 1, calculation of P1. For the purpose of P1 calculation, we'll apply a simple formula. P0 is equal to D1 plus P1 divided by 1 plus K. This is a formula which is required to be applied. So we will have D1 plus P1 is equal to P0 into 1 plus K. So P1 is equal to P0 into 1 plus K minus D1. Okay. What is P0? It is 200. What is cost of equity? It is 12%. Minus D1. So P0 is provided to us as rupees 200. K is 12% minus D1, that is dividend. So 200 into 1.12, that comes to 224 minus D1. We understand that the question is providing the information that so the dividend is declared, dividend is not declared. So D1 is rupees 10 and D1 is 0. In both the situations, we have to compute the answer. So it is 224 minus 10, that is 214, and 224 minus 0 is 224 itself. That is the way the P1 is calculated. Step number 2, calculation of delta N. Dear students, the term delta N stands for change in the number of equity shares. Yes, we are required to make the computation of the change in the number of equity shares, that is issue of the additional equity shares in both the cases, if the dividend is declared and if dividend is not declared. Afterwards, we'll compute the value of the firm. So I'm taking the D1 value as 0 and D1 value as 10. In both the cases, we'll compute delta N. Okay, so let us start with the profit. It has been given to us, so we are going to have the profit of an amount of 5 lakhs. From the profit, we will deduct ND1. The term ND1 stands for dividend paid to the existing shareholders at the end of the year. We can see that the number of equity shares are given as 40,000 and the amount of dividend per share is 0. So 40,000 into 0. So no dividend is paid in the first case. So we will have the retained earning. It is an amount of 5 lakhs. How much we have earned? 5 lakhs. What is the dividend payment? No dividend payment. So what is retained earning? Again 5 lakhs. Investment. It has been given that say we are going to expand our business, and for expansion we are going to have an amount of 10 lakhs to be invested. Okay. We are going to have the expansion of the business by 10 lakhs. We already have 5 lakhs in form of retained earning. So there is going to be new issue of balancing figure 5 lakhs. 10 lakhs minus 5 lakhs. Okay. Now what will happen if at all we do not pay any earning in form of dividend? Then in that case, so the price of equity share at the end of the year will be 224. So P1 is 224. Next is delta N. Delta N is the change in the number of shares. It means that how many additional shares are required to be issued in order to finance the requirement of balance funds. 5 lakhs upon 224. That comes to 2232.14. We are ignoring fraction. So 2233. Let us say that this is the number of equity shares that will be issued. Okay, if at all the dividend is rupees 10 per share, what will happen? Again, the profit of the company is 5 lakhs. Number of equity shares are 40,000. Dividend per share is rupees 10. So it comes to 4 lakhs. We have earned 5 lakhs, dividend is 4 lakhs. So what is retained earning? 1 lakh. Because dividend per share is given to us as rupees 10. Okay. So it is 5 lakhs minus 4 lakhs. That is the amount of the retained earning. We are going to expand our business by an amount of 10 lakhs. 10 minus 1, so new issue will be 9 lakhs. That is 10 lakh minus 1 lakh. If at all we pay dividend of rupees 10, then in that case market price of the equity share will be rupees 214. So what will happen? It is 9 lakhs divided by 214. That comes to 4205.61. So let us take 4206. Because in India right now we cannot issue fraction number of shares, so we just round off. That is the way, so we make the computation of the delta N, that is the change in the number of shares. Next, we'll compute NP0, that is current value of the firm. Step number 3, calculation of NP0, current value of the firm. Dear students, it will be calculated by using a formula like this: N plus delta N into P1 minus investment plus profit divided by 1 plus K. This is the way we are required to apply the formula. This answer is required to be calculated again in 2 ways if dividend is not declared. That is D1 is 0. In that case, how we will compute the answer? Let us see. Existing number of shares are 40,000. If dividend is not declared, then in that case we have to issue additional shares of 2,233 to finance the requirement of balance funds. Multiplying with, we understand that if dividend is not declared, then in that case price of equity share will be 224 minus investment. The amount of the investment is 10 lakhs plus profit 5 lakhs whole divided by 1 plus K. What is cost of equity given to us in the question? 12%. Okay, so let us use the calculator. 40,000 plus 2233, 42,223. Multiply with 224. That comes to 94,60,192 minus 5 lakhs. That is 10 negative, 5 positive. So difference of both of them is 5 lakhs negative. So minus 5 lakhs. Divide by 1.12. It comes to 89,60,192 upon 1.12. That comes to 80,171. I'm ignoring that 171 value because it is only because of the rounding of that we have done over here. So we are writing the answer, it is 80 lakhs. Yes, 80 lakhs. And friends, we can always verify the answer. We know that say existing number of equity shares are provided as 40,000 and presently the market price of the share is given as 200. So multiplication of both of them is 80 lakhs. This is the way we can do answer. The first one is D1 is 0. Similarly, we have to do the next one wherein D1 is 10. Okay, in that case, let us understand how to calculate the answer. It is again n plus delta n into P1 minus I plus P whole divided by 1 plus K. This is the way we are required to do answer. What is existing number of shares? 40,000. Plus, if at all the dividend is declared, then in that case, delta N is 4206. Into P1, that is market price of equity share, which is 214 because this is 214. Minus 10 lakhs plus 5 lakhs whole divided by 1.10. Okay, so using calculator once again, 40,000 plus 4206, 44,206 into 214, that comes to 94,60,084. Minus 10 lakhs plus 5 lakhs divided by 1.10. So minus 10 lakhs plus 5 lakhs, 89,60,084. Whole divided by, 1.12. Cost of equity is 12%. So divided by 1.12. That comes to 80,75,000. Again, we are ignoring that 75 rupees value and the answer would be 80 lakhs. This is the way we are required to do answer. So I'm just revising the entire answer. First of all, in step number 1, we'll make the calculation of P1, taking into account the dividend, taking into account the price and cost of equity. In step number 2, we'll make the calculation of delta N. Delta N will be calculated taking into account the investment, retained earning, price and all other things. In the third step, we'll calculate the NP0. As far as the current value of the firm is concerned, it will be calculated as N plus delta N into P1 minus investment plus profit divided by 1 plus K. That is the way, so the current value of the firm can be calculated. And we can see that in both the cases it is same and it is bound to be same. So as per approach, payment of dividend does not have any impact on value of firm. So we write the conclusion like this. payment of equity dividend comma will not have any impact on value of firm. This is what we understand. Starting with the question number 2. Sophisticated Limited is considering, highlight the portion, 3 financing plans. The key information is as follows. The total investment amount to be raised is 4 lakhs. Plans of financing have been given A, B and C. In case of A plan, we will be having 100% equity financing. That is, entirely 4 lakh rupees will be raised by way of equity share capital. In case of B plan, we will have 50% equity financing and 50% debt financing. 4 lakhs into 50%, so 2 lakh rupees is equity financing and 2 lakh rupees is the debt financing. In the last case, again 50-50. So this is 2 lakhs and this is again 2 lakhs. This is the way the financing proportion is given. Cost of debt is given 10% and cost of preference share is 10%. Dear students, Institute has made very clear with its suggested answer. Unless the post-tax cost of debt is given, we don't have to understand it to be KD. We have to understand cost of debt as a rate of interest. Income tax rate is only 30%. Equity shares of the face value of 10 will be issued at a premium of 10. So 10 plus 10, 20 rupees is the issue price. Operating income is given as 10 lakhs. You are required to determine for each plan, that is for first, second and third, earning per share, financial break-even point, and indicate if any plans dominate and compute the EBIT indifferences, that is EBIT range among the plan for indifferences. That is the question. Let us see that how to make the calculation of answer for this question. We understand that for the purpose of calculation of earning per share, we have to compute first of all earning available to equity shareholders. The same will be divided with the number of equity shares to compute the EPS. That is the sequence in which we have to do answer. That is the first thing. Second thing that we understand that for the purpose of calculation of earning per share, we'll make computation of the number of equity shares that we are going to issue. In case of A plan, it is 4 lakh rupees divided by 20. So number of equity shares will be 20,000. In case of B plan and in case of C plan, 2 lakh rupees divided by 20. That is the way we'll compute the number of equity shares that will be issued by the company. This is the sequence in which we have to do answer. So let us start calculating the answer. Working note number 1, calculation of number of equity shares to be issued. We understand it is amount of equity financing divided by issue price of equity share. This is the way we are required to calculate the answer. Plan A, Plan B and C. For Plan B and C, we don't have to do it separately. In case of Plan A, it is 4 lakhs into 100% divided by 10 plus 10. So what will happen? It is 4 lakhs divided by 20 rupees per share. That comes to 20,000 equity shares. In case of Plan B, Plan C, what will happen? It is 4 lakhs once again into 0.5. Why? Because 50% is equity financing divided by 10 plus 10. So it is 2 lakhs divided by 20. That comes to 10,000 shares. So this is the way we can make the computation of, first of all, number of equity shares that will be issued. Working note number 2, or we can say that's the calculation of earning per share. Earning per share is required to be calculated for Plan A, for Plan B and for Plan C. Information is provided to us as expected operating income as an amount of 10 lakhs. Okay, so let us see Plan A, Plan B and Plan C. For each of them we are required to find earning per share. Let us start making calculation of the earning per share. We start with EBIT. Let us start with the C plan. Operating income is given as 10 lakhs. Amount of interest is 0. Why? Because in that case we are having 50% preference share capital and 50% equity share capital. So EBIT minus interest, that will give earning before taxes. That is an amount of 10 lakhs. Income tax rate is only 30%. So earning after taxes will be 70%. 10 lakhs into 0.7, that comes to 7 lakhs. From earning after taxes, we will subtract the preference dividend. So what will happen? It is 4 lakhs into 0.5. Preference share capital is 2 lakhs into 10%. 2 lakhs into 10%, that comes to 20,000. Earning after taxes minus preference dividend will give earning available to equity shareholders. That is 6,80,000. Dividing the same with the number of equity shares. We understand that, say 2 lakh divided by 20, number of equity shares are 10,000, for which we already have prepared a working note over here. Earning available to equity shareholders divided by number of equity shares, that will give EPS. EPS is 68. So it is 6,80,000 divided by 10,000 equity shares. That is the way earning per share can be calculated. Let us see in case of B plan what will happen. Again, operating income is 10 lakhs. Amount of interest 4 lakhs into 0.5 into 10%. So it is 2 lakhs into 10%, that comes to 20,000. EBIT minus interest, earning before taxes, 9,80,000. So earning after taxes is 9,80,000 into 0.7, 6,86,000. that is 9,80,000 into 0.7. There is no payment of the preference dividend because there is a combination of the debt and equity. So earning available to equity shareholders will be 6,86,000. That is earning after taxes minus preference dividend 0. Number of equity shares are 10,000. And earning per share will be 68.6. Okay, next. Again, the operating income is 10 lakhs. The first plan is an unlevered plan wherein we don't have any outsiders financing. Interest is 0. EBT is 10 lakhs. EAT is 7 lakhs. Preference dividend is 0. Earning available to equity shareholders is again 7 lakhs. Number of equity shares are 20,000. That is 4 lakhs upon 20. So 7 lakhs upon 20,000. That comes to 35. This is the way earning per share can be calculated for each of the financial plan. Okay. The second part of the question, it says that so you are required to compute the financial break-even point. Dear students, the term financial break-even point is indicating the level of the EBIT at which earning per share is 0. So let us see how to make the calculation of answer. Financial break-even point is calculated as interest plus preference dividend divided by 1 minus t. That is the way financial break-even point can be calculated. So again it is A, B and C for these 3 financial plans. As far as the C financial plan is concerned, in that we understand the amount of interest is 0. Amount of the preference dividend is 20,000 and income tax rate is only 30%. So 20,000 divided by 1 minus 0.30. 0 plus 20,000 divided by 0.7. So 20 upon 0.7, that comes to 28571. That is the way we can make the computation of the financial break-even point for C financial plan. In case of B, it is 20,000, that is amount of interest. And in case of A, it is 0. Why? Because we do not have any fixed financial charges. This is the way financial break-even point can be calculated. That is the level of EBIT at which EPS would be 0 of the respective financial plan. Next is the question says that say indicate if any of the plan dominate and compute the EBIT range among the plan for indifferences. So in the third part of the question, we are required to make the calculation of the financial indifference point. So let us make this calculation of answer. Financial indifference point between financial plan 1 and financial plan 2. Let us see how to calculate the same. Dear students, financial indifference point is indicating the level of the EBIT at which EPS is same for both the financial plans. So basically the company is indifferent whether to select the first financial plan or to select the second financial plan. Let us see how to calculate the same. We understand that earning before interest and taxes minus interest, that is earning before taxes into 1 minus t is earning after taxes minus preference dividend is earning available to equity shareholders divided by number of equity shares of first financial plan is equal to, on the opposite side, EBIT once again minus interest into 1 minus t minus preference dividend divided by number of equity shares of second financial plan. That is the way we can compute the answer. I am assigning x variable to EBIT minus interest. We understand that the first financial plan is an unlevered plan, so the interest is 0. 1 minus tax rate, which is 30%. There is no preference dividend, divided by number of equity shares of the first plan, that is 20,000. Is equal to, on the other hand, we'll keep the same equation. X, that is the level of EBIT, minus the amount of interest. The interest amount is 20,000. Into 1 minus tax rate. Preference dividend is 0, divided by number of equity shares at 10,000. This 10,000 is getting cancelled. 20 upon 10, that comes to 2,000, that is 2. X minus 0 is of course x. 1 minus 0.7, 0.3 is 0.7 divided by 2 is equal to, on the other hand, 1 minus 0.3 is 0.7. So x into 0.7 is 0.7x. 20,000 into 0.7 is 14,000. Now we'll make the computation of the x as balancing figure. Again, what we can do, dear students, we can cancel this 2 over here. We can cancel over here 0.7. 0.7 divided by 2, that comes to 0.35. So we will have 0.35x is equal to 0.70x minus 14,000. 14,000 is transferred on the opposite side, and from negative it will become positive. So 0.70x minus 0.35x is equal to 14,000. So x is equal to 14,000 divided by 0.7. That comes to 20,000. I'm sorry, 14,000 divided by 0.35. So I think it will be 40,000, yes. So we understand that, say, 40,000 rupees is the level of EBIT at which EPS of the first financial plan and second financial plan would be same. Now let us see how to calculate the financial indifference point between 1 and 3. Financial indifference point between 1 and 3. Let us see how to make the calculation of answer. EPS of 1 is equal to EPS of 3. EPS of 1 is EBIT minus interest, that is EBT, into 1 minus T, EAT, minus preference dividend, earning available to equity shareholders, divided by number of equity shares of first plan is equal to, same numerator, EBIT minus interest is EBT, into 1 minus T is EAT, minus preference dividend is earning available to equity shareholders, divided by number of equity shares of third financial plan. X minus, what is interest? 0. What is income tax rate? 30%. What is preference dividend? 0. Divided by, what is the number of equity shares? 20,000. On the opposite side, X minus interest is 0 once again, because the third financial plan has preference share capital and not debentures, into 1 minus tax rate once again, minus preference dividend is 20,000, divided by number of equity shares are 10,000. So this 10,000 is getting cancelled against this 20,000. So 20,000 upon 10,000, that comes to 2. X minus 0 is X. 1 minus 0.3 is 0.7, divided by 2. On the other hand, X minus 0 is X into 1 minus 0.3 is 0.7X, minus 20,000. Okay. 2 is cancelled from the division. 0.7 divided by 2 is 0.35. So we will have 0.35x is equal to 0.70x minus 20,000. 0.35 is transferred on the opposite side. So 0.70x minus 0.35x is equal to 20,000, because 20,000 is also transferred on the opposite side. So x is 20,000 divided by 0.35. That comes to 57,143. That is the way we are required to make calculation of answer. Next is financial indifference point between second financial plan and third financial plan. So EPS of 2 is equal to EPS of 3. EBIT minus interest is EBT into 1 minus T is EAT minus preference dividend divided by number of equity shares of second financial plan is equal to, on the opposite side, same formula. It is EBIT minus interest EBT into 1 minus T EAT minus preference dividend divided by number of equity shares of the third financial plan. Now we are required to solve this equation. Let us assign x variable to the EBIT minus amount of interest in the second financial plan is 20,000. Income tax rate is only 30%. Second financial plan does not have any preference dividend. Divided by number of equity shares are 10,000. On the opposite side, x once again, no interest. Income tax rate is only 30%. Minus preference dividend is 20,000. Whole divided by number of equity shares are 10,000. Number of equity shares are cancelled over here and number of equity shares are cancelled over here. Okay, 10,000 is cancelled on both the sides. 1 minus 0.3 is 0.7. 0.7 into x is 0.7x. 20,000 into 0.7, that comes to 14,000. On the other hand, 1 minus 0.3 is 0.7 into x is 0.7x minus 20,000. Now what will happen? 0.7x is there on both the sides, so it is getting cancelled. So we understand that say x is getting cancelled on both the sides, so there is no indifference point between second and third financial plan. There is no financial indifference point between second and third financial plan. That is what we understand. Dear students, the reason for that is very simple. We can see that in second and third financial plan, the amount of the equity financing is same. Whatever is the amount of the debentures in the second financial plan, itself is the amount of the preferential for the third financial plan. That is what we can see. These two values are same. Further, we can see that the rate of interest and the rate of preference dividend are same. However, whatever the interest that you pay, for that you get the tax saving, and your post-tax cost of debt financing is going to be lesser, and that is the reason always second financial plan will have more EPS than the third financial plan. Since second is always, that is plan 2 is always better than plan 3, there is no indifference point between second and third financial plan. In case of first and second, we understand that the first financial plan would have more EPS than second, below 40,000, and vice versa. Between first and third, first one will have more EPS below 57,143, and again vice versa. That is the way, say, between first and second, first and third, the financial indifference point is existing. However, in case of second and third, always second is better, so there is no indifference point. So please write down one line answer. Second financial plan has debt financing equal to preferential capital of third financial plan. Full stop. So second financial plan has always an advantage of interest tax saving. Full stop. Hence, plan 2 is always better than plan 3. Full stop. Between first and second financial plan, comma, between first and second financial plan, second financial plan is better than first, comma, beyond rupees 40,000 and vice versa. With paragraph written down, between first and third financial plan, comma, first is better than third, comma, below rupees 57,143 and vice versa. Now friends, this is the point at which the question comes to an end. However, I just draw a diagram for you for your understanding purpose. Of course, this does not form part of the answer. It is only for understanding purpose that you will find only at the place like Navkar. Dear students, on x-axis we are taking operating income, that is earning before interest and taxes. And on y-axis we are taking earning per share. We understand that, say, as far as the financial break-even point is concerned, that is the point at which the earning per share is 0. So it is 0, 20,000 and 28,571. So over here we understand that the diagram will go like this. This is the financial plan 1, wherein it is absolutely the equity financing. Then this is financial plan 2, wherein it is combination of the debt and equity. This is the second financial plan. Then this is the third financial plan. Which will be having combination of the equity and preferential. That is what we understand. Between first and second financial plan, there is an intersection point over here. And that is what we understand is a financial indifference point between first and second financial plan. That is an amount of rupees 20,000, sorry, rupees 40,000. This is 0, this is 20,000, and this is 28,571. Between first and third financial plan, again there is a financial indifference point. That is an amount of 57,143. That is the point at which EPS of first and third financial plan would be same. This is the way, so we can have an understanding Importantly, friends, what we can see that the second and third financial plan are going parallel. It means that the 2 is always better than 3. That is what we understand. Third question. Sadbhavna Limited is a manufacturing of the computers. It wants to introduce artificial intelligence (AI) while making computers. It estimates that annual savings from artificial intelligence (AI) include reduction of 5 employees with an annual salary of rupees 3 lakhs each. Rupees 3 lakhs from the reduction of the production delay caused by the inventory problem, and reduction in the loss of sales 2,50,000 and 2 lakhs from billing issues. The purchase price of the system for installation of the AI is an amount of rupees 20 lakhs with an installation cost of 1 lakh. The lifespan of is 5 years and it will be depreciated on straight line method basis. The salvage value is 0, which will be its market value at the end of the 5 years. However, the operation of the new system for AI requires 2 computer specialists with an annual salary of 5 lakh rupees per person. Also, estimated maintenance and operating expenses of 1,50,000 is required. Income tax rate is only 30%. Discounting rate is 12%. From above information, calculate initial cash outflow and operating cash flow over a time period of 5 years. Evaluate the project using highlight the portion payback period method, NPV and PI. You are required to obtain the cash flows in NPV on the assumption that the book salvage value for depreciation purpose is 2 lakhs, even though the machinery is having no real worth in terms of its resale value. Also, the book value of 2 lakhs is allowed for the tax purpose. That is the way we are required to do the answer. So friends, it is basically about the modernization. So the first part of the question says that you are required to that is calculate the initial cash outflow. That is step number 1 that we do usually. That is year 0 cash outflow. If at all we take this decision positively. And annual operating cash flow means something like step number 4, wherein we take into account the savings, we take into account the depreciation, additional expenses and so on. So basically in the first part of the question, we are required to make the calculation of the initial cash outflow. That's very simple. It is an amount of 20 lakhs and this is an amount of 1 lakh. So it comes to 21 lakhs. So answer for question number 3. In the breakdown, working note number 1, calculation of depreciation. It is cost divided by number of years. What is the cost? It is 20 lakhs plus 1 lakh divided by 5. So 21 lakhs divided by 5. It comes to 4,20,000 rupees per year. That is the way the depreciation can be calculated. Next is working note number 2. That is, we can say that's a calculation of initial cash outflow. Let us see that's how to calculate the same. It is purchase price 20 lakhs plus installation cost. So total comes to 21 lakhs. That is what we understand is the initial cash outflow, that is in the year 0. Then importantly, calculation of annual cash flow. In that we will have working like this. Savings of, we have been provided with the number of savings of the salary, an amount of rupees 3 lakhs each, and we are going to retrench 5 employees. So savings of salary, (3 lakh into 5), that comes to 15 lakhs. Then 3 lakhs from the, that is reduction in the production delay. Reduction in production delay. An amount of rupees 3 lakhs. Then 2,50,000. That is reduction in the loss of sales and billing issues. Reduction in loss of sales. Okay. So these are the savings. Then depreciation. For that we already have prepared the working note. It is an amount of 4,20,000. Next is additional expenses, that is salary cost 5 lakh rupees per person, and 2% are going to be appointed. ₹5 lakh into 2, that comes to 10 lakhs. Maintenance and operating expenses 1,40,000, that is 1,50,000. Okay. So these expenses will be deducted from the revenue. So let us see how to make the calculation of cash flow. Savings of salary 15 lakhs plus reduction in the production delay plus 3 lakhs plus 250 plus 2 lakhs minus 420 minus 10 lakhs minus 150. So savings before taxes is 6,80,000. Income tax rate is only 30%. So savings after taxes is 70%. 4,76,000. Since depreciation is a non-cash item, it will be added back to compute the cash flow. So 4,76,000 plus the amount of the depreciation is 4,20,000. So it is 8,96,000. This is the amount of the recurring cash flow that we will have, say, for the new project. Now, after making the calculation of the cash flow, first part of the question is over. Second part of the question says that evaluate the project using payback period method. Means we are required to compute the payback period of the project. So answer for the second part of the question. Calculation of payback period. It can be calculated by two methods. Method number one. In the first method, we will have working note number one. Calculation of cumulative cash flow. Column number one is year. Column number two is cash flow. Column number three is cumulative cash flow. It is 8,96,000. Second year it is 17,92,000. It is 8,96,000 plus 8,96,000. Third year, it is again 8,96,000. So cumulative will be 26,88,000. So it is 26,88,000. So it is 1792 plus 8,96,000. Dear students, we have made investment of 21 lakhs. And we can see that it is recovered after 2 years, but before 3 years. So the payback period will be 2 years and something. Now friends, over here, we understand that there is no need to make the computation for 4th and 5th year because we are able to recover the investment within 3 years. So the answer will be 2 years plus 21 lakhs minus 17,92,000 divided by 8,96,000. So 21 lakhs minus 17,92,000, that comes to 3,08,000 divided by 8,96,000. So 0.34375. So it is 2.34 years is the time period in which we are able to recover the investment. That is the way the payback period can be calculated. Dear students, in this question, method number 2 is possible because yearly the cash flow is same. That is the reason. Otherwise, every time it is not possible. In subsequent method, what we will do, dear students, it is investment divided by annual cash flow. Amount of the investment that we have made is 21 lakhs and annual cash flow is 8,96,000. So 21 lakhs divided by 8,96,000. So it is 2.34375, directly the answer that we get. So it is 2.34 years. That is the way, so we can make the computation of the payback period of the project. Now let us make the calculation of NPV. So that on heading, calculation of NPV of the project. Dear students, the second part of the question is NPV calculation. The question is providing the information that the discounting rate is 12%. However, the annuity factor information is not given to us. So what we will do, we understand that say yearly the cash flow is 8,96,000. That is the amount of the cash flow from end of year 1 to end of year 5. That is discounted in present value term, and from that the investment will be deducted for the purpose of NPV calculation. This is the way we are required to make the NPV calculation over here. The amount of the investment will be taken, an amount equal to rupees 21 lakhs. So I request all of you to write down answer along with me for NPV calculation. It is year 1 to year 5. The recurring cash flow is 8,96,000. Discounting at the rate of 12%, and based on that, so the present value will be calculated. 1 divided by 1.12, first year factor is 0.8929, second year 7972, third year 7118, next 6355, and it is 0.5674. So 0.8929, 7972, 7118, 6355, 5674. So 3.6048. Into 8,96,000. That comes to 32,29,000.8. 29,900.8. That is what we understand is the present value of the cash inflow. From that, investment is deducted, an amount of 21 lakhs, and with that, so the NPV is calculated. The amount of the NPV is 11,29,900.8. That is where the NPV is found. So since NPV is positive, we can say that the company should go ahead with the new technology, that is AI. Next is PI. Calculation of the PI is very simple. It is calculated as present value of the cash inflow divided by investment. What is present value of the cash inflow? This is the present value of the cash inflow, 32,29,900.8. Divided by investment. Amount of investment is 21 lakhs. So based on that, so we can compute the PI. $1.5380 That is the way the PI is calculated. So we can take decision like this. As NPV is positive, comma, the company should implement AI, full stop. We can also say that as PI exceeds 1, comma, the company should accept the project. That is, the company should implement AI. Third part of the question says that so you're required to obtain again the cash flows, and you're required to compute NPV on the assumption that book salvage value for the depreciation purpose is rupees 2 lakhs, even though the machinery is having no real worth in terms of its resale value. It means that say you are required to consider the 2 lakh rupees as the book salvage value at the end of 5 years. Also, the book salvage value of 2 lakhs is allowed for tax purpose. So the 2 lakh rupees of the book salvage value will be considered as short-term capital loss, and the company will get the advantage of its tax saving. That is what we understand. So friends, over here we understand that say first of all we are required to compute the depreciation. So answer for the third part of the question, in that working note number 1, calculation of depreciation. It will be calculated as cost minus book value divided by number of years. What is the cost? It is an amount of 21 lakhs. What is the book value? Book value is 2 lakhs. Divided by how many years? It is 5 years. So 19 lakhs upon 5, that comes to 3,80,000 rupees per year. That is the way, first of all, we'll make the computation of depreciation. Next is calculation of the recurring cash flow, which was otherwise required for NPV calculation. So calculation of recurring cash flow. In that, we understand that whatever the working that we already have made over here, that is required to be adjusted to some extent. See, the depreciation that we have written over here is 4,20,000, and based on that we have found the savings before taxes of 6,80,000. So we understand that say savings before depreciation and taxation 6,80,000 plus 4,20,000, that comes to an amount of 11 lakhs. Less depreciation, new depreciation is 3,80,000. So we get savings before taxes, it is 11 lakhs minus 3,80,000, 7,20,000. Income tax rate is given to us as 30%. So savings after taxes will be 70%. $5,04,000. Since depreciation is a non-cash item, so we will add back the same. It is 3,80,000, and that will be useful to calculate cash flow after taxes. 5,04,000 plus 3,80,000, that comes to 8,84,000. This is the way we can make the computation of recurring cash flow. Next, calculation of capital gain or loss on capital, that is calculation of capital gain or loss. We understand that at the end of the 5 years, the AIEs has resale value 0. So sale value of the software is 0 and its WDV is 2 lakhs. Because we have claimed depreciation in such a way that it would have the WDV of 2 lakhs. So there is a capital loss of an amount of 2 lakhs. Okay. Now understand carefully, all of you, that whatever the loss that we have, that will be eligible for the purpose of tax deduction. Like that specifically credit is made in the question. Even otherwise we will make that assumption. Okay. So capital loss tax savings is an amount of 60,000, that is 2 lakhs into 30%. This is the way we are required to make the calculation of answer. Next will be calculation of NPV. Okay, let us understand and say how to make the NPV calculation. It is year 1 to year 5 and 5th year. Column number 1 is cash flows. Column number 2 is discounting rate at the rate of 12%. And the last column is present value. As far as the recurring cash flow is concerned, it will be now 8,84,000. As far as the 5th year cash flow is concerned, it is an amount of rupees 60,000. Discounting 12%. In that we can see that the annuity factor for 5 years is 3.6048 and the last year factor is 0.5674. So this is 0.5674 and this is 3.6048. So kindly use a calculator. 8,84,000 into 3.6048, that comes to 31,86,000. $643.2. 60,000 into 0.5674, 34,044. Based on that, so we will have PVCI. It is 32,20,000, 687.2 minus investment. Amount of investment is 21 lakhs. And difference between both of them is NPV. The amount of the NPV will be 11,20,687.2. That is the way the NPV can be calculated. So NPV is calculated by us, cash flows and NPV. And of course, once again we understand that the decision is going to remain same. That the AI should be implemented because NPV is positive. So write down final answer. the company should implement AI, comma, because NPV is positive. This is the way we can write the answer. Let us see question number 4. The following figures and the ratios are related to a company. Sales is provided an amount of 30 lakhs. GP ratio is 25%. So COGS is 75%. Fixed asset turnover ratio, highlight the portion based on COGS. Dear students, if at all such kind of clarification would not have been given, we would make an assumption that the fixed asset turnover ratio is given to us based on the sales revenue. Stock turnover ratio, they have clarified that it is based on the COGS. That clarification is not required because we always make an assumption that it is based on the COGS only in absence of an information. Liquidity ratio is given, current ratio is given. Receivable collection period, that is average collection period, is given. Reserves and surplus to share capital is 0.6. Is-to-1 does not make a sense. Why? Because any ratio is always understood to be is-to-1 only. If it is other than is-to-1, only in that the case the clarification should be made. Capital gearing ratio is 0.5, which is understood to be 0.5:1. Fixed asset to net worth is 1.20. You are required to prepare balance sheet of the company on the basis of above details and statement showing working capital requirement if the company wants to make a provision for contingencies at the rate of 10% of net working capital. Highlight the portion including such provision. So this is the way we are required to say calculate first of all, that is we are required to prepare first of all the balance sheet, and then we are supposed to compute the working capital. Dear students, in case of the ratio analysis questions, my suggestion to students are like this, that always first of all you have to see that in the entire question any value is given. Yes, so always focus that this value can be used in which ratio. So you have to take that ratio and then you can start with the working. We understand that the GP ratio is like the gross profit divided by sales into 100. In a way that say sales we have, GP ratio we have, so we can compute GP. Yes, it is 25% of 30 lakhs. We can compute COGS. Yes, it is sales minus GP. Fixed asset turnover ratio is given to us. So based on this we can compute the fixed asset. Stock turnover ratio is given to us. So we can make the computation of the stock. Once you make the computation of the stock, you have the liquid ratio and current ratio, that is liquidity ratio or asset test ratio, that is what say you have, and current ratio. So you can make the computation of the current liabilities, you can make the computation of the current assets. Average collection period is provided to us as 2 months. Do you have the sales value? Yes. Whatever the sales value that is provided to us in the example is given to us specifically that it is on credit. Even if such clarification would not have been given, we will make that assumption. So that will be useful to make the computation of the debtors. Okay, reserves and surplus to share capital, capital gearing ratio, and fixed asset to net worth. See, fixed asset to net worth information that will be helpful to us to make the calculation of net worth. Net worth is going to be bifurcated into reserves and share capital. This capital gearing ratio will be helpful to us to calculate the long-term debt, because basically we understand that the capital gearing ratio is calculated as debt plus preference share capital divided by equity plus reserves and surplus. This is the formula that we apply. However, we understand that directly or indirectly No information is given for the preference share capital, so we assume that the preference share capital is 0, because otherwise you cannot calculate the two values from this one equation, and the balancing figure in the formula will be debt financing. This is the way we are supposed to prepare the balance sheet. So let us start making the calculation of answer one by one. So answer of the question, in that calculation of gross profit, it is calculated as sales into GP ratio. What is the sales value? It is 30 lakhs. What is GP ratio? It is 25%. That comes to 7,50,000. Then we can make the calculation of COGS. It will be calculated as sales minus gross profit. Sales is 30 lakhs and gross profit is 7,50,000. So it is 22,50,000, that is COGS. Next is calculation of fixed asset. In that case, fixed asset turnover ratio is equal to COGS upon fixed asset. So fixed asset is COGS upon fixed asset turnover ratio. We understand that the fixed asset turnover ratio is 1.50. So what is the numerator value? 22,50,000 divided by 1.50. That comes to an amount of rupees 15 lakhs. That is the way the fixed asset is calculated. Next will be calculation of stock. So we'll apply the formula like this: stock turnover ratio is equal to COGS upon stock. Stock is equal to COGS upon stock turnover ratio. As far as the COGS value is concerned, it is 22,50,000. Divided by 6. So 22,50,000 divided by 6 is 3,75,000. That is the way the stock is calculated. Next is calculation of current assets and current liabilities. Let us understand how to calculate the same. Liquidity ratio or asset test ratio is current assets minus stock divided by current liabilities. So liquidity ratio or asset test ratio is given to us as 1. So 1 into current liabilities is equal to current assets minus stock. Stock value is 3,75,000. Okay, so current assets is equal to 3,75,000 transferred on this side, so it will become positive, plus current liability. There are two variables and one equation, we cannot solve it, so we keep it as it is. Next is we'll use the information for the current ratio. It is current assets upon current liabilities. Current assets value is replaced with this value 3,75,000 plus current liability. Divided by current liability. As far as the current ratio is concerned, so that is provided to us as 1.50. So current liability is transferred on the left hand side, so it will become 1.50 current liability minus current liability is equal to 3,75,000. So 0.50 current liability is equal to 3,75,000. So it is 3,75,000 divided by 0.5. That comes to 7,50,000. This is the way the current liability can be calculated. Once we have the current liability, based on that, say we can compute easily the current assets. Current assets is equal to current liability plus 3,75,000. $7,50,000 plus 3,75,000. It is 11,25,000. This is the way the current assets is calculated. Next, the question is providing the information about the receivable collection period that is going to be helpful to calculate the debtors. Calculation of debtors. Let us see in that average collection period is equal to 12 months divided by annual credit sales into debtors. So as far as the debtors is concerned, it is annual credit sales divided by 12 months into average collection period. That is what we understand. So it is 30 lakhs divided by 12 months into 2 months. That comes to an amount of 5 lakhs. This is what we understand. Next information is provided to us. I skip this two information for the time being and I am making calculation of net worth. Calculation of net worth. In that, fixed asset to net worth, fixed asset upon net worth. Fixed asset to net worth is 1.20. As far as fixed asset value is concerned, that we already have calculated. It is an amount of 15 lakhs. Divided by net worth. So as far as the net worth is concerned, it is 15 lakhs divided by 1.20. It comes to 12,50,000. This is the way the net worth is calculated. Now we'll use this two information, that is reserves and surplus to share capital is 0.60. So calculation of reserves and surplus and share capital. Reserves and surplus is 0.6:1. Reserves and surplus to share capital is 0.6:1. So the total is 1.60. Net worth is 12,50,000. So what will happen? We can compute the reserves and surplus as balancing figure. That is 0.6 divided by 1.6 into 12,50,000. 1 divided by 1.6 into 12,50,000. So use a calculator. 0.6 into 12,50,000 divided by 1.6. That comes to 4,68,750. So 12,50,000 minus 4,68,750. So it comes to 7,81,250. This is the way we are required to compute reserves and surplus in share capital. After this, the next working is calculation of the long-term debt. And for that, so the ratio is given to us as 0.50. So calculation of long-term debt. In that, write down we are assuming that preference share capital is 0, comma, with that long-term debt is found. That is, with that assumption, long-term debt is found. We'll apply the formula. Capital gearing ratio is calculated as debt plus preference share capital divided by equity plus reserves and surplus. Capital gearing ratio is provided to us as 0.50. What is debt is required to be calculated, plus preference share capital is 0, divided by equity share capital plus reserves and surplus. So 781,250 plus 468,750. So as far as the debt financing is concerned, it is 7181250 plus 468750. Addition of both of them into 0.50. 7181250 plus 468750, it is 12,50,000 into 0.5. That comes to 6,25,000. This is the way the debt financing is calculated. Okay. So almost all the information have been used by us. So let us prepare the balance sheet. Mostly all the values are available with us for doing answer. So we understand that's the balance sheet. Of the company to be prepared. So liability amount, asset amount. Okay. So we start with the equity share capital. That is an amount of 781,250. Next is reserves and surplus, 468,750. Next is long-term debt. It is 6,25,000. Current liabilities, 3,75,000. Sorry, it is 7,50,000. On the asset side, we have the fixed asset. The amount of the fixed asset is 15 lakhs. No information is given for any investments, so we are ignoring it. Debtors, it is an amount of 5 lakhs. Stock, that is 3,75,000. And other current assets, or we can say that it is the cash balance. We understand that the total current assets is an amount of 11,25,000. This is the total current assets. Minus debtors 5 lakhs minus stock is 3,75,000. So based on this we can compute the cash balance. 11,25,000 minus 5 lakhs minus 3,75,000. So it is 2,50,000. This is the way we can prepare the balance sheet. 781,250 plus 468,750 plus 6,25,000 plus 7,50,000. So it comes to 26,25,000. As far as the current assets are concerned, it is 15 lakhs plus 5 lakhs plus 3,75,000 plus 2,50,000. That is again 26,25,000. This is the way we can prepare the balance sheet. That is the first part of the answer. The second part of the question says that you are required to prepare a statement showing working capital requirement if the company wants to make a provision for contingencies. Okay, so let us make first of all the working capital calculation and then we'll add the provision for contingencies. So write down heading calculation of working capital requirement. In that we will start with the stock, debtors, cash and bank, so total of all of them will be current assets. Current liabilities, for that no bifurcation is given to us, so we are writing current liabilities in total. Dear students, number of times students are having a question to ask me that sir, can we write all of them in total, that is the current assets, that is 11,25,000, because the balance sheet is going to tell you even otherwise. However, institute is expecting you to give answer in detail so far possible. So always show the separate values because adequate information is given to compute debtors, to compute stock. That is the reason. The next is the working capital requirement. In that, as far as stock is concerned, it is an amount of rupees 3,75,000. Debtors it is an amount of 5 lakhs. Cash and bank it is 2,50,000. Current liability it is 7,50,000. So at this point of time we'll compute the working capital before margin for contingencies. That is the way we are supposed to make the calculation. So now let us see working capital requirement before margin for contingencies. 3,75,000 plus 5 lakhs plus 2,50,000 minus 7,50,000 and it comes to 3,75,000. Next is a margin for contingencies. Friends, over here you can see that the question is providing that if the company wants to make a provision for contingencies at the rate of 10% of the net working capital. Suppose over here there is a full stop and this information is not given. Then in that case the margin for contingencies will be simply 37,500. How 37,500 is calculated? It is 3,75,000 into 10%, that comes to 37,500, which is added to 3,75,000 to calculate the answer. This is what's the answer that we would have returned. However, the question says that including such provision. So in that case what happens, that as far as the margin for contingencies is concerned, it will be found like this. It is 100, 10 and 90. In a way that the working capital that is working capital requirement before margin for contingencies is 90% of the total requirement. So what will happen? Margin for contingencies will be calculated as 3,75,000 into 10 divided by 90. It is not into 10%, it is into 10 divided by 90. So 3,75,000 divided by 9, it comes to 41,667. So based on that, we will compute the total working capital requirement. As far as the total working capital requirement is concerned, it is 3,75,000 plus 41667, it is 4,16,667. This is the way, so we are required to make the calculation of answer. This is an important working over here which is required to be made for calculation of the margin for contingencies. So this word that they have provided, this information is very important for you to understand. Next question. The following details of PQ are limited for the year ended 31st of March 2021 is given below. DOL is 1.4, DCL is 2.8, excluding interest the fixed cost is 2,10,000, sales is 40 lakhs, 10% debentures is 25 lakhs, equity share capital of rupees 10 each 20 lakhs, income tax rate is only 30%. You are required to calculate, the first question answer is DFL, degree of financial leverage. Second, calculate the profit volume ratio and earning per share. Third, if the company belongs to an industry whose asset turnover ratio is 1.6, does it have high asset turnover ratio or low asset turnover ratio? At what level of the sales EBT of the company will be 0? In the question, assume 10% of the debentures and share capital consist of total liabilities. That is the way they have provided the information. So this is the question of the leverage, in which we understand that say we are already provided with two leverages and we are required to compute the third leverage. That is the question. Now let us understand how to make the calculation of answer. First of all, we can compute the degree of financial leverage. Let us have understanding that's how to make the calculation of answer. So answer of question number 5A, in that DFL, that is what we are going to calculate. For the purpose of calculation of DFL, we'll use the formula DCL, degree of combined leverage, is equal to DOL into DFL. So as far as the DFL is concerned, it is DCL upon DOL. Degree of combined leverage is given to us as 2.8 and operating leverage is 1.4. So the answer comes to 2. That is the way the DFL is calculated. The question further says, next question, calculate profit volume ratio. And further the question says that you are required to compute the earning per share. Dear students, the language of the question is very clearly providing that what is the amount of the fixed cost excluding interest. It is 2,10,000. So we can make the calculation using this, the fixed cost excluding interest, that is operational fixed cost, and DOL, we can make the computation of the contribution. So next is the calculation of contribution. Let us see how to calculate the same. DOL is contribution upon EBIT, which is calculated as contribution minus fixed cost. DOL value is 1.40 is equal to X upon X minus fixed cost. What is the fixed cost? 2,10,000. So we can make the computation of the contribution as balancing figure. Sales is already provided to us in the question. So contribution upon sales will give the answer of the profit volume ratio. So now 1.40 into x, so 1.40x minus 1.4 into 2,10,000, that is 2,94,000. X is transferred on the opposite side, so it is 0.40x is equal to 2,94,000. X is equal to 2,94,000 divided by 0.4. Answer comes to 7,35,000. That is the way we make the computation of the contribution and finally profit volume ratio. As far as the profit volume ratio is concerned, it is contribution upon sales into 100. Contribution is 7,35,000. Divided by sales, it is an amount of 40 lakhs into 100. That comes to 18.375%. This is the way PV ratio can be calculated. Next, the question says that you are required to calculate the earning per share. So next is calculation of EPS. We already have found the contribution. We have the fixed cost. With that, we will calculate the operating income and so on. Further calculation will be made. So we start with the contribution 7,35,000 less fixed cost. Fixed cost is 2,10,000. That will give us EBIT 7,35,000 minus 2,10,000. So 5,25,000. Interest. It is 25 lakhs is the value of the debentures and rate of interest is 10%. So the amount of the interest is 2,50,000. So that will give us earning before taxes. $2,75,000. Earning after taxes is 70%. That comes to 192,500. Because the tax rate is provided as 30%, number of equity shares will be 2 lakhs. 20 lakhs divided by 10. 20 lakhs is the equity share capital. Face value of equity share is 10. So this will be helpful to us to calculate earning per share. So 192,500 divided by 2 lakhs, that is 0.9625. This is the way we can make the calculation of earning per share. Please take down answer. So this is the way earning per share is calculated. Let us see the next one. The question says that if the company belongs to an industry whose asset turnover ratio is 1.60, does it have high asset turnover or low asset turnover? That is a question. So friends, over here we understand in the third question we are required to compute first of all asset turnover ratio. So calculation of asset turnover ratio. It will be calculated as sales upon assets. That is the way it is calculated. What is the value of the sales? It is an amount of 40 lakhs. Dear students, with respect to the assets, sufficient information is not given. So we'll make the calculation of the assets as consisting of the equity plus debentures. So it is equity share capital plus debentures. So it is 40 lakhs divided by equity plus debentures. In that, it is an amount of 20 lakhs and 25 lakhs. $20 lakhs plus 25 lakhs. So it is 40 lakhs upon 45 lakhs. That is the way we'll compute the asset turnover ratio. It is 0.89 times. We understand, dear students, that asset turnover ratio is indicating what is the value of the sales for every 1 rupee of the asset. We understand that say the industry has asset turnover ratio of 1.6 and this company has asset turnover ratio of only 0.89. So asset turnover ratio of this company is comparatively less. So definitely turnover ratio of the company is not so encouraging. That is what's the kind of comment that we have to write. So write an answer. The company has asset turnover ratio comma 0.89, which is substantially less than industry. Full stop. Next, the question says that at what level of the sales earning before taxes of the company will be 0. So the question says that whatever is the earning before taxes, it reduces to 0, means there is a negative change by 100%. So in the fourth part of the question, we can make this calculation like this. First of all, working note number 1, calculation of percentage change in earning before taxes. How to do the same? DCL is equal to percentage change in earning before taxes divided by percentage change in sales. This is the formula that we have. Now we are going to compute that what would be the percentage change in sales, because we know that the percentage change in EBT is 100%. So percentage change in sales is equal to negative 100%. Okay, entirely it is reducing by that amount, divided by 2.8. So it is 100 divided by 2.8, that comes to 35.71. This is the way the percentage change in sales is calculated. Okay. Revise the sales is equal to current sales minus change in sales. The current sales is given to us in the question as 40 lakhs minus 35.71%. That comes to 25,71,600. This is the way the revised sales is calculated. So over here the question says that at what level of the sales EBT will be 0. We understand that say when the sales value will reduce to 25,71,600, EBT will be 0. So we can write one line conclusion. When sales value will drop to rupees 25,71,600, comma, EBT, earning before taxes, will be 0. This is the way we can write the answer. I am summarizing the entire answer, dear students. First of all, we have made the calculation of DFL using the information of DOL and DFL. Then we have made the calculation of the contribution so that we can compute the profit volume ratio, and that comes to 18.375%. Next is earning per share calculation, that is 0.9625. Asset turnover ratio, that is sales minus assets, and it has been given very clearly that on the liability side there are only two things, that is equity share capital and debentures, that is 0.89. Afterwards we are required to make the computation what will be the revised sales value if the company, that is if the EBT reduces to 0. It means that the percentage change in EBT is 100%. Based on that we are making calculation of answer. Now friends, of course the question is over. However, I would like to give you some more explanation over here. See, the first question is the question wherein we are required to compute the DFL. See, as a student you may have, say, you might do working like this, which I feel is absolutely acceptable. What you can do, dear students, taking into account the information about the fixed cost, taking into account the information of degree of operating leverage, first of all you can make the computation of the contribution, that is an amount of 7,35,000. This is what you can do, and for that the process that we already have understood, 7,35,000. Fixed cost is given to us in the example 2,10,000. EBIT 5,25,000. Language of the question is very clearly providing. In the question, assume that 10% debentures and share capital consist of the total liabilities. So the amount of the interest is 5,25,000 and EBT is 2,75,000. So I repeat that, say what I want to tell you friends, I want to tell you that first of all you make the calculation of contribution. For that, so you have to apply the formula of DOL. Then you make the calculation of earning before taxes. For that, so you have to prepare the table, and then you can make the calculation of DFL. For DFL, the formula would be EBIT upon EBT. What is EBIT? You can see that so the EBIT is 5,25,000. And what is EBT? It is 2,75,000. So over here it is 5,25,000 divided by 2,75,000. So 5,25,000 divided by 2,75,000. So the answer is 1.9091, which I feel is absolutely acceptable. Of course, friends, over here, what will happen? If at all you make the calculation like this, then in that case, it is deemed for you to understand that the degree of combined leverage value will also automatically change. And that value will not match with this value which they have given to us in the question. Because there is an error in providing the information of the question. Actually, if at all you prepare the statement and you apply the formula, the DFL value should be 2 exactly, the way we have done over here. However, in this kind of question, Institute has very clearly provided that doing answer by either of the method is acceptable. So just I am telling you that you might do answer like this in examination, because something like this will strike in your mind. As far as the asset turnover ratio is concerned, in that there is no change, that is sales upon assets. At what level of the sales EBT will be equal to 0? Now friends, over here you have to understand it like this, that DCL, if at all we take the DFL, this will be 1.4 into 1.9091. That comes to 2.6727. This is what we will have the DCL. So DCL will be 2.6727. So what will happen in the fourth part of the question? Again, what will happen? It is 100 divided by 2.6727. That comes to 37.42%. So 40 lakhs minus 37.42%. Accordingly, the answer will be 25,03,200. This is the way you are required to write the answer. Or otherwise, listen carefully, you can also do the backward working. You can do the backward working like this. The amount of the EBT is 0. Amount of the interest will be 25 lakhs into 10%, 2,50,000. So EBIT 2,50,000. Amount of the fixed cost is 2,10,000. So this is 4,60,000. And the profit volume ratio has already been found by us. It is 18.375%. So 4,60,000 divided by 18.375%. So it is calculated as 25,03,401. What I want to tell you is that since there is a mismatch of the information in the question, so you can do answer by either of the method which is acceptable in examination. You just have to put a note that if at all you are doing the answer the way I have just explained to you, you can just put a note that we are ignoring the DCL information which is given to us in the question. And if at all we do answer like this, then in that case, of course, you can see that if at all we make the computation of the DFL, 525 divided by 275, it is 1.9091, but we are ignoring that fact and taking DFL value 2, we are doing answer. This is the way we are doing answer. Because friends, if at all you take the sales value equal to 25,71,600, then definitely EBT will not be 0. Because this calculation is considering that this is 2.8, but actually it is not 2.8, it is 2.6767. So this is what we understand. So just be careful for this kind of certain different kind of question that we may have in examination. 5B, the question says that write a short note on electronic fund transfer. That is the question. electronic fund transfer with the development which took place in IT, your favorite subject, information technology, the present banking system has switched to the computerization of the bank branches to offer efficient banking services and cash management services to their customers. The network will be linked to different branches, banks. This helps the customer in following ways. Instead updating of the accounts, you can send a message that is missed call and you'll get the message for the balances. Quick transfer of the funds from one account to another account. Instant information about foreign exchange rates. Friends, over here we can definitely add certain more advantages with respect to the virtual banking. We understand that say you don't have to go to update your passbook. You can get say the statement on the computer directly without incurring any expenses, and you can get it on the that is any time. You don't have to visit to the bank branch say for the purpose of deposit of the check. You will be able to get say the transfer through the net banking. Like that, say there are number of advantages say which you know, which you are day to day like enjoying all those advantages that you can mention. Automated teller machine, that is ATM, wherein you can withdraw the cash at any point of time and you are not bound to say withdraw the cash in the banking hours from the bank only. These are the advantages that say we have. Next question. Question number 6A. Briefly explain three finance function decisions. The three finance function decisions are as follows. Investment decision, wherein you have to write everything that say you know in the capital budgeting. That is what say you are required to write. Financing decision, whatever you study in your capital structure theories that you have to write. Dividend decision, so whatever you have studied in the dividend like theory that you have to write. You just have to remember this head points: capital budgeting chapter, capital structure theory chapter, and dividend chapter. Investment, that is financing, and the last one is the dividend. That's it. In investment decision, we understand something like this. Let's say you are required to properly scrutinize the investment proposal. You are required to make sure that say you are having say the better forecasting. We have to make sure that say we are having say the enough the risk analysis that say we have made. All those things that say you are required to mention. These decisions relate to selection of the assets in which funds will be invested by the firm. It may be a new project. It may be expansion of the existing business. It may be like something like say opening of the new branch, replacement of a machinery, something like that. The funds procured from the different sources have to be invested in various kinds of assets. Long-term funds are used in a project for various fixed assets and also for current assets. The investment of the funds in a project has to be made after a careful assessment of various projects through capital budgeting. A part of the long-term funds is also kept for financing the working capital requirement. Because friends, the working capital requirement is not only for the short term, but it is for the long term too. These decisions relate to acquiring of the optimum finance to meet the financial objective and seeing that fixed and the working capital are effectively managed. The finance manager needs to possess a good knowledge of the sources of available funds and their respective costs and the needs to ensure that the company has a sound capital structure. That is a proper balance between the equity and debt. So this is very important decision. Let's say you are having a proper balance of the equity and debt, because highly levered firm, there are definitely very high chances that the company will go into the liquidation. Such managers also need to have a very clear understanding as the difference between profit and cash flows, bearing in mind the profit is of the little use unless the organization is adequately supported by the cash to pay for the assets and sustain the working capital cycle. Dividend decision. 3 decisions relate to determination of how much and how frequently cash can be paid out of profit of an organization as income for its owners or the shareholders. In a way that say whatever the earning available to equity shareholders, from that how much earning is to be paid in form of dividend and how much earning is to be reinvested in the business is required to be decided. The dividend decision thus has 2 elements: the amount to be paid out and amount to be retained to support the growth of the organization. The latter being a financing decision. The level and the regular growth of the dividend represents a significant factor in determining a profit-making company's market value. So when you make the payment of the dividend on the regular basis, then in that case you will be able to have the good image in the market, and with that, so you will be able to capture the high market price in the market, that is value placed of the shares by the stock market. Explain sensitivity analysis and its various steps. Dear students, we know that there are number of factors which influence the NPV of the project. That includes investment, selling price, variable cost, sale units, fixed cost, life of the project, and so on. We understand that say any of the variable which is adversely changing, it will have say an adverse impact on the NPV of the project. If at all the variable cost increases, NPV will fall down. Selling price reduces, NPV will fall down. Sale units reduces, NPV will fall down. Investment increases, NPV will fall down. So basically the sensitivity analysis is measuring that say what is the impact on NPV for such adverse changes. Yes friends, the emphasis over here is on the adverse factor. If at all something is changing adversely, what is the impact that it will have on NPV? That is what say we understand is what the sensitivity analysis is measuring. We understand that say the factor due to which that is highest impact, that is considered to be most sensitive for the project. Sensitivity analysis, put in simple terms, a modeling technique which is used in the capital budgeting, which is used to study the impact of changes in the variable on the outcome of the project. What kind of variable? As I have told you, selling price, variable cost, units, and so on. In a project, several variables like weighted average cost of capital, consumer demand, price of the product, cost price per unit, and so on operate simultaneously. The changes in these variables impact the outcome of the project. It therefore becomes a very difficult to assess change in which variable impact the project outcome in a significant way. In sensitivity analysis, the project outcome is studied after taking into account change in one variable. Yes, this is an important assumption. The sensitivity analysis is making an assumption that say there is only one change at one point of time. The more sensitive is the NPV, more critical is the variable. Means the factor due to which NPV of the project is say reducing at a larger rate, then in that case it is considered to be more sensitive for the project. For example, we take 5% adverse change in each of the variable and we observe that say how the NPV is changing. The variable because of which there is maximum reduction in NPV is most sensitive. So sensitivity analysis is a way of finding impact in the project's NPV or IRR for a given change in one of the variable. Sensitivity analysis is conducted by the following steps as below. Finding variables which have an influence on the NPV or IRR. Establishing mathematical relationship between the variables. Means for 5% change, what is the change in NPV? And this change, remember, will always take adverse. Analyze the effect of the changes in each variable on NPV or IRR of the project, and the variable which is having the maximum effect will be considered to be most sensitive for the project. Suppose the most sensitive variable comes to the selling price. Then we will report to the management that say if at all because of any reason we are required to reduce the selling price, then be very conscious. We have very less margin of safety with respect to the selling price per unit. In addition to that, number of times we also make the computation of the sensitivity analysis by taking the break-even calculation. Yes, we make the calculation that what is the maximum reduction in selling price that we can afford, what is the maximum increase in the variable cost that we can afford, what is the maximum increase in the fixed cost that we can afford. All those things that can be done, and based on that we can measure that what is the margin of safety in percentage term. The variable which is having the least margin of safety will be considered to be most sensitive. Write two main objectives of the financial management. That is the next question. The two main objectives of the financial management is profit maximization and wealth maximization. It has traditionally been argued that primary objective of the financial management is to earn profit. Hence, objective of the FM is also the profit maximization. This implies that the finance manager has to make his decision in a manner so that the profits of the concern are maximized. So they always have to take a decision which is going to maximize their profit. Each alternative therefore is seen to be to whether or not it gives maximum profit. Means always you are required to see that every decision making from maximization of the profit point of view. Wealth maximization or value maximization. We will first like to define what is wealth, what is value maximization model. Shareholders' wealth are result of cost benefit analysis adjusted with their timing and the risk. That is time value of money. So the wealth is equal to present value of the benefit minus present value of the cost. So basically friends, present value of the cost is the investment that you make, and present value of the benefit means whatever the investment that you make right now will have certain advantages in future. It is important that the benefits measured by the finance manager are in terms of the cash flows. Finance manager should emphasize, should give importance on the cash flows for investment or financing decisions, not on accounting profit. The shareholders' value maximization model holds that the primary goal of the firm is to maximize its market value and implies that the business decision should seek increase in the net present value of the economic profit of the firm. Briefly describe the financial needs of the business. The financial needs of the business. The business enterprise need funds to meet their different types of the requirement. All the financial needs of a business may be grouped into the following three categories. It is long term, it is medium term, and it is short term. Such needs are generally referred to those requirements of the funds which are for a period exceeding 5 to 10 years. All investments in plant, machinery, land, building, and so on are considered as long-term financial needs. Medium term, such requirements refer to those funds which are required for a period exceeding 1 but not exceeding 5 years, that is 1 to 5 years range. Short term, in that so the such types of financial needs arises to finance current assets such as stock, debtors, cash and so on. Investment in these assets is known as a meeting of the working capital requirement of the concern for a period which is not exceeding 1 year, that is less than 1 year. So column number 1 is question number. Column number 2 is like practical or theory. Column number 3 is chapter. Next is marks, and in last I would say that's it is remark. This is a way, say, let us have a kind of discussion of the entire paper. So starting with the question number 1A, it is a practical question from the chapter of capital structure theory. It is 5 marks. And it is from the chapter capital structure theory. It is about the approach, arbitrage. I would say that it is a good question, not very extremely simple question. The reason behind that is that over here number of times the students fail to do this kind of question. So I would say it is a good question. One good thing about this question is that there is a good clarification made in the question, that you are required to increase your earning. That is what we understand. Otherwise, what happens, I'd say you have to make an assumption that for the same investment you have more income, or with the less investment you have the same income. Question number 1B, it is from the chapter of cost of capital. 1B practical question, 5 marks, from chapter of cost of capital, and it is again a simple question. One good clarification made again in this question is that you are required to adopt the market value approach for calculation of WACC. Again in that, students have number of times confusion. The reason is that the clarification is not made by the institute, and the suggested answer of the institute sometimes provide the book value proportion, sometimes market value, so they have that kind of confusion. But fortunately over here, there is no such confusion. The next is a question, with respect to the ratio analysis, a very simple question. Question number 1C, practical question from the chapter of ratio analysis. It is 5 marks question. Very simple question and short question too. 1D, it is from the dividend policy. That is again extremely simple question. Similar to this, number of questions have been provided by institute in module dividend policy. 5 marks question, and it is again a very simple question. Second question, that is about cost of, that is the capital structure theory once again. 10 marks question. It is about the financial plans. So earning per share calculation, financial break-even point calculation, financial indifference point calculation. One good thing is that you have to understand, between the debt plus equity plan and preference share plus equity plan, there is no indifference point. So I would say that's it. Because of that point, it is a good question. Otherwise, a very simple question. Third question, in that, it is from the chapter of capital budgeting. It is capital budgeting question, again of 10 marks, and I would say that it is not so simple. It is a good question, especially for the second part of the question, wherein we have been provided that say you'll keep some salvage value of the asset, that is the software that you have purchased, and then we will be having say the lost tax saving. Fourth part of the question, in that ratio analysis, very simple question. $10 marks question. That's an extremely simple question which is provided to us over here. And second part of the question, working capital requirement. Similar to this, say number of questions have been provided by the institute earlier. The only thing that's for which you have to take care is that's the capital gearing ratio. In that we will assume that the preference share capital is 0. Question number 5a, it is of leverage. Practical question of 8 marks, that is of leverage. Because of the wrong formulation of the question, yes, because internally the data is not matching, so I would say that say be careful for this question. Otherwise I don't think that it is a good question for revision, but just be careful, because similar to this institute has asked number of times questions in examination, so just be careful. I have provided to you both the answers. It is theory question, not so difficult, the entire theory portion of the question. It is 5b, that is electronic funds transfer from the cash management chapter, and question number 6 is entirely theory. 6a, 6b, 6c, and in that say the 6c or. In that case it is 4 marks, 4 marks and 2 marks. It is theory, not so difficult. That is what we understand. See, in my opinion, if at all you are confident for the question number 1, you may start. Otherwise you may like do question number 1 later on, because question number 1 once that is a number of times is very complicated. If it is simple, then in that case it is very time consuming. So if at all we see that say from the question that say you can start, we can say that say the capital structure theory question, capital budgeting, ratio, leverage, these questions are the questions from which you can always start. If at all your capital budgeting is not so strong, you may do that later on. Otherwise from these questions you can start. And if at all one of the practical chapter is not so done, that is so well done by you, then in that case you can do the theory. In theory you can see that say out of 4 questions you have to attempt the 3 questions. Of course A and B, in that say you don't have a choice, and between these 2 you have a choice. So what I would like to tell you is that say suppose like I am not very confident for the capital budgeting question, but I am confident for 6B and 6C. Then at least I should be attempting the theory, wherein out of that 6 marks, if at all my answer is correct, I'll get full 6 marks or at least 4 to 5 marks. And I can attempt this question wherein I may be able to score 1 mark at least. This is the way the paper analysis is there.